So the starting point for this paper is this old idea that for a country, being open to the rest of the world is somehow useful, and that it can expose a country to new ideas or new technologies, and this can somehow raise standards of living. So the idea goes back a long way. More recently, there's been an empirical debate, or empirical literature looking at the relationship between openness and growth. And I think it's summarizing this literature, it's fair to say that the literature maybe at best is inconclusive, but is at least suggestive that there is a relationship, a positive relationship between a country being open and growth. And I want to emphasize in particular some recent work that was done by Jim Ferris, two very clever papers looking at the relationship between openness and growth and trying to get at strategies to identify the causal effect of openness on growth that can address several of the problems that plague the previous literature. And the latest results are very encouraging. So he found fairly big, a fairly strong relationship between openness and growth. So on the one hand, we have the experience of growth miracles. These are experiences of countries like Korea, Taiwan, Singapore, countries that enacted a number of reforms, including opening up to the rest of the world, lowering trade barriers, and over the next 30, 40 years experienced very high growth rates that lasted a very long time. On the other hand, when we've looked at what we're going to call the impact of static trade mechanisms, or standard trade mechanisms that have been studied in the literature, these standard mechanisms imply relatively small impacts of the opening up to trade on growth. And in particular, I want to point out the work of Michelle Connolly and Kei-Mo Yi, who looked at the Korean growth experience and found that opening up to trade, including bells and whistles such as roundabout production and importing capital goods, I found that what we call the standard neoclassical mechanisms can explain about a sixth of the increase of Korea's increase in standards of living. So we think that a promising alternative to these quote-unquote standard mechanisms are that an economy can, opening up to trade, can expose the economy to new ideas and can lead to the diffusion of ideas across technologies. So what are we going to do in this paper? So we're going to study an explicit model of how ideas diffuse across individuals based on their local interactions. So we're going to build on some, I think, some really important work by Sam Kortum, Bojan Jovanovic, and more recently by Bob Lucas and Fernando Alvarez and co-authors in modeling the flow of ideas as ideas that are embedded in individual people, and through their local interactions with other people, these ideas can spread across individuals. There's a particular strand of this literature that we're going to fit in most directly, which is looking at how trade shapes the particular interactions that people have. More recent work by Alvarez, Lucas, Perlotin, Thomas Sampson looked at trade can shape which producers are active, which producers sell goods, and by changing the people who are active, that changes the insights one might learn. So if the more productive firms expand, the less productive firms drop out, then it's easier to learn the better quality ideas. It's easier to get better quality insights by learning from people who are actually active. In this paper, we're going to make just a small tweak to the learning process. We're going to model the learning process a little bit differently, and we're going to show that we're going to argue that it's a useful tweak. So the idea is when I learn a new idea, I learn a combination of an idea that's an insight from somebody else and an original component of an idea, sort of a combination of the innovation and diffusion process. And you can think of this in a number of ways. You can think of that as when I want to apply someone else's idea to my own production, there's kind of some noise in how well that idea applies to my production. Or you can think of it as more of an innovation process that I create new ideas, but there are some spillovers I get from other people's innovation. There are different ways of thinking about that process. But overall, we're going to show, under certain parametric assumptions, we're going to show that this process leads to what we call a general Frechet limit. Sort of however you specify the interactions, the set of people who I might learn from, the distribution of ideas in a country is going to converge asymptotically to a Frechet distribution. So this is particularly useful in a trade context in which the set of individuals might be learning from people in different countries that are coming from, have different productivities and different productivity distributions. However we specify the learning, the process, we're always going to, the distribution of ideas is always going to converge to a Frechet distribution. So that's going to be useful because we can take these off-the-shelf models, the Eden-Cordom model, Bernard Eden, Jensen-Cordom, Alvarez and Lucas, these models of trade, or models of multinational production, in particular the model by Raimondo and Rodriguez-Clare, and just take those models right off the shelf and plug those into our models. So those models will provide a static equilibrium, and our model will provide the dynamics of that equilibrium over time. And so the model is going to provide very tractable dynamics, and in particular, I think the comparative advantage of this specification of learning is going to be particularly useful in studying environments with many asymmetric countries and potentially transition dynamics over time. As you'll see, these models, these trade models and models of multinational production have been very successful quantitatively. The ultimate goal of this project is to have a quantitative model of idea flows. We're not quite there yet. We'll show you some preliminary results today, but I think that's where we're trying to push this project. So we're going to take this model and we're going to ask a couple of questions. So the first question is, how does the opening up to the rest of the world affect the development process, and is there at least the potential for the model to explain growth miracles? And so here we come away with a positive answer. So we're going to look at gains from trade, and we're going to separate the gains from trade into a static component and a dynamic component. So the static component is the usual gains from trade, such as the ones described by Arkolakis, Cosno, Rodriguez-Clare, just the gains from trade we study with our static trade models. The dynamic gains from trade are the gains from trade that operate through the flow of ideas across countries. So in this model, we're going to show that there's potentially very large dynamic gains from trade, and particularly for countries that are very close to autarky. The intuition there is that if a country is close to autarky, lowering trade costs just a little bit is going to let in a little bit of extra goods, and our static trade models say that's a little bit good. But from the dynamic perspective, opening up for a closed economy, when you lower trade barriers just a little bit, that lets in a little bit of good, but it's the most productive producers who are expanding, who are the first entrants, or the ones who are expanding the most, and the ones who you can learn the most from. So it's countries near autarky that have the most to gain. We're also going to show that this model, this specification of learning, can lead to very protracted dynamics. So if we want to explain growth miracles, we want to be able to have high growth rates for a long period of time. And there's at least the potential for the convergence process to take quite a while in this model. We're also going to write down the model in such a way that we can nest a couple of different specifications of the learning process in the literature. So the literature so far has studied, I would say, two different learning processes. One is that individuals might learn, and they learn from people who sell goods to them. All the people who sell me goods, I might learn the ideas behind their goods. A second specification of the learning process is that I learn from those who are producing in my country, all the domestic producers in the country. And when the set of domestic producers change, I might change who I interacted with and the ideas that I learn. So we're going to study these different mechanisms, and we're going to ask when does it matter, when does it not matter, what are the differences across these different mechanisms, how can we tell them apart? So we're going to show that the specifications of the learning process is going to determine how the dynamic gains from trade spill over across countries and within countries. And it's also going to matter for the speed of convergence to a new balanced growth path when something changes in the environment. We're also going to ask about whether there's a role for changing trade barriers and whether changing trade barriers can improve growth outcomes for a country. We're going to show that free trade is not necessarily the optimal environment here. So free trade will maximize the static gains from trade, but it won't necessarily maximize the dynamic gains from trade. So a country could perhaps learn faster by tilting its trade toward specific countries. And again, I'll show you the model is going to be rich and tractable enough that it can be taken to cross-country data. And what we're ultimately interested in is whether we can explain growth miracles, these experiences of catch-up growth. And this is a work in progress. We'll show you just some very preliminary results about this today, just to give you a taste of what will be coming later. But I think this is ultimately where we want to take the paper. Okay, so I'm going to start by talking about the learning process in general and talk about this Frechet limit that we have. Then I'll embed the learning process within a trade model and talk about the gains from trade and the different learning mechanisms. For one slide, for most of the talk, the arrival of new ideas is going to be just some exogenous, set exogenously. For one slide, I'll talk about incentives for innovation and incentives to do R&D. And after that, I'll talk about a quantitative exploration. And in particular, we're going to focus on the experience of South Korea. And if there's time, I'll talk about embedding multinational production in this model and how that changes the learning process as well. And in particular, whether trade and multinational are complements or substitutes in the learning process, which works well in terms of learning faster. So start by talking about the learning process in general. So the basic environment, there's going to be a continuum of goods, a unit continuum of goods indexed by the letter S. For each of the goods, there are going to be M managers, M potential producers of the good. So there are a set of people for whom it is feasible to produce that good, a large number of these managers. Eventually, we're going to be studying an environment with Bertrand competition, so only the most productive of these managers are actually going to be producing, but at least in principle, there are many people for which it is feasible to produce the good. A manager is going to be summarized by a number Q, which is the productivity with which that manager can produce the particular good that he's able to produce. So the manager's productivity may improve over time if he learns new ideas. And so ideas are going to sort of drop down randomly on this environment. Ideas are going to arrive stochastically to individuals via a Poisson process, and there's going to be some arrival rate alpha, which may or may not be varying over time, that governs the arrival of ideas. A new idea has a productivity embedded in it, a productivity with which that manager can produce his particular good. And the productivity is composed of these two components, an insight from somebody else and an original component to an idea. So these two are both, when an idea is drawn, these are both randomly drawn from different distributions. So the original component of an idea is just drawn from some exogenous distribution with CDF H. The insight from somebody else, that's drawn from what we call a source distribution, which we're giving the notation G tilde. The source distribution just summarizes the productivity of all the individuals that a manager might learn from. Okay, so there's interactions, the particular trade flows and things like that are going to shape the individuals that a manager might learn from. And G, this source distribution, summarizes the productivity among the people that a manager can learn from. Okay, and so this source distribution eventually is going to be an endogenous object that depends on the environment. For now, we're just taking it as given and asking what does it imply about the change in managers' productivities. And a manager is going to adopt a new idea if the productivity delivered by the new idea is better than his number Q. There's a parameter beta here which measures the strength of diffusion in the economy. We're going to call it the strength of diffusion. When beta is 0, the insight from somebody else doesn't matter at all. And so when beta is 0, we nest sort of a simple model of pure innovation. It's only the original component of an idea that matters. And we recover a simple version from Sam's 1997 paper when beta equals 0. There's no diffusion, but we have a model of pure innovation. On the other hand, we can also nest a version of some of Bob's work, a model with pure diffusion when the strength of diffusion equals 1, and when the original component of idea is just degenerate. So the people have modeled the diffusion process is I meet somebody and I learn their productivity directly, and we can nest that by making beta equal 1 and making z just equal to 1. This original component just not matter. And so we can nest these two extreme cases. Okay, so we're going to follow some previous work it's going to be useful to summarize how the distribution of productivity over these agents changes over time. And there's two things we're going to track. First is the distribution of productivity among individual managers. This is going to have the CDF capital M. And we're also going to track, even more important than that is going to be what we call the frontier of knowledge. For each individual good, we want to keep track of what is the best possible way across all the different managers of producing that good. So F tilde is going to be our notation for the frontier of knowledge. It's just going to be you look across all the different little m managers who are able to produce a good. The probability that none of those managers are able to produce the good with productivity better than q is just m of q to the little m. Okay, so the frontier of knowledge summarizes for each individual good the best possible way of producing that good. So first we're going to look at the change in the distribution of knowledge among managers. So who are the managers who have productivity no better than q at time t plus delta? Well, it's all the managers who had productivity no better than q at time t, who didn't get a new draw that was better than q, whose idea didn't improve enough so that their productivity became better than q. And so for an individual manager, why my productivity remain worse than q? It's either because I didn't get a new idea, or I did get a new idea, which comes at rate alpha t, and that idea was just no better than q. And if either of these two things happen, then my productivity remains worse than q at time t plus delta. So we can rearrange this equation and take the limit as the delta goes to 0, and we get a simple law of motion for how the distribution of knowledge among managers changes over time. So the log of the fraction of managers with productivity no better than q declines when managers get new ideas, which happens at rate alpha, and those ideas, and an idea is better than, delivers a productivity better than q. So if a new idea arrives that delivers productivity better than q, I jump out of this pool of managers who have productivity worse than q. So with this equation over here, we have a law of motion for the distribution of knowledge among managers. If we wanted to talk about how the frontier of knowledge changes over time, we have a definition of the frontier of knowledge up there, which means we can have almost exactly the same law of motion for the frontier of knowledge. We just have this extra m term over here. And so the frontier of knowledge is going to improve over time when any of the m managers, an idea arrives to those managers that delivers productivity better than q. And lastly, we have the probability that a new idea delivers productivity better than q is going to depend on these two things. So a new idea has these two components, the original component and the insight from others. And so to get at the probability that a new idea delivers productivity better than q, we just have to integrate over the source distribution and the distribution from which the original components are drawn. It's a convolution over these two distributions. And beta, the strength of diffusion, plays a role in which one of those is more important. Okay, so we have a law of motion for the frontier of knowledge in terms of the source distribution of insights and other structural parameters of the model. We're going to come to this slide as our sort of the main result from this part of the paper. We're going to make some assumptions about the structural parameters of the model. 3 assumptions. The first one, I think only one of them is well, the first one is the one with the most content, which is that the original component of a new idea is drawn from a distribution with a Pareto tail. Okay, so just asymptotically, this distribution, which summarizes the original component of a new idea, has a Pareto tail with shape parameter theta. So when theta is small, there's a lot of variation across how the original components of new ideas. Theta is small means sometimes I get a fantastic original component, sometimes I get a terrible original component. Okay, so just in the upper tail of this distribution, there's a Pareto tail. We're also going to make a second assumption that the source distribution doesn't have too much mass in the upper part of the distribution. Okay, the insights aren't too good that you can sort of get the average insight that I get is infinite. Eventually, so the source distribution eventually is going to be an endogenous object in the model that depends on traded interactions. So eventually, we're going to replace this distribution with a distribution about the initial conditions. That the initial conditions, the initial distribution of knowledge across managers doesn't have too much mass at the upper end. So Urzo likes to make, makes assumptions like this, saying that the initial distribution of knowledge is bounded. That would work just fine here. And the assumption we're going to make is that the strength of diffusion, this parameter beta, is strictly less than 1. The behavior of the model changes qualitatively when beta is strictly less than 1 or beta equals 1. And it's a little bit like going from an AK model to a model with decreasing returns to scale in capital.
If you relax that assumption and make beta equal to 1,
yeah.
Isn't it going to mess up with the previous assumption? So isn't it?
It depends.
Make this G tilde distribution become very fat tail every time? So even if you start from a very thin tail or even a bounded initial distribution, isn't it going to start?
Yes.
With convoluting with this H distribution that has a fat tail, it's going to tend to become fat tail. And so
that's, so it depends on the initial distribution. So there's some part of the distribution which is going to retain the shape of the initial distribution. It will have a fat tail. The qualitative distinction that's going to happen is one, whether or not the economy experiences endogenous growth or semi-endogenous growth, and two, whether if beta equals 1, the distribution of productivities is going to look more like a log logistic distribution, whereas if beta is strictly less than 1, it's going to look like a Frechet distribution. So there's qualitatively different dynamics in the model when beta equals 1 and beta is less than 1. Just like in endogenous growth models, whether there's exact scale economies or a little bit less than perfect constant returns to scale and innovation, the behavior changes. It does make a difference whether beta equals 1 or beta is less than 1. We're going to be focusing on the case where beta is strictly less than 1. Okay, so with these assumptions, we're going to study how the frontier of knowledge changes over time. And it's going to be useful, instead of studying the frontier of knowledge and the source distribution, it's going to be useful to study the frontier of knowledge, but scaling productivity by the number of managers. So this F tilde and G tilde are the frontier of knowledge and the source distribution. We're going to study the sort of a normalized version of that, just with productivity scaled by the number of managers in the economy. So when we make these assumptions, when the number of managers per good becomes large, and when time goes to infinity, the frontier of knowledge within a country is always going to converge to a Frechet distribution. There are two important parameters for this Frechet distribution. There's a shape parameter, theta, which is the same as the shape parameter of the tail of this component, this original component of ideas. And so the shape of the Frechet distribution is going to inherit the upper tail of the shape of the distribution of the original components of new ideas. The more important object here is going to be the scale parameter. So the scale parameter lambda is what we're going to call the stock of knowledge within a country. Okay, and when the stock of knowledge is something that's going to change over time. And how does the stock of knowledge evolve? The stock of knowledge grows when ideas arrive to the different managers into the country. And the stock of knowledge, the growth in the stock of knowledge is going to depend on the source distribution, the insights that arrive. So a better source distribution, if I have better quality insights, that's going to generate better quality ideas, and that's going to raise the stock of knowledge faster. Beta, the strength of diffusion, also plays a role in how important all these insights from others play in increasing my stock of knowledge. So what I want you to take away here is that no matter what the source distribution is, no matter what the interactions are, the frontier of knowledge is still going to have this convenient form. It's going to converge to a Frechet distribution over time. I think the big difference is which of these two distributions dominates the upper tail of new ideas. And as I said before, if you make the source distribution, these insights dominate the upper tail, then you get something that is more familiar from diffusion models. You get sort of this logistic distribution of ideas across goods, and which is much closer to what Alvarez, Barrow, Lucas do. And the distribution of ideas across country is going to depend on the initial conditions and the slope of the upper tail. What's going to be convenient here is that the upper tail is going to be dominated by this original component of the idea, which is something, it's a structural parameter that's going to be the same across countries. Which means that in these trade models, it's really important to have the slope of the upper tail be the same across, the shape parameter of the Frechet distribution be the same across countries to get tractability. So you can make the different countries as asymmetric as you want, but as long as it's the original component of the idea that's dominating the upper tail, we're always going to end up in this Frechet distribution. You could specify the model both ways, and you get different results. But we think it turns out to be very convenient to specify the model in this way. That we can, you still have these impacts where a better source distribution is going to lead to a higher rate of growth. It's just that we end up with these functional forms that are very useful in terms of plugging into these quantitative trade models. Okay, so I'm going to start with just a really simple example describing this. So here, managers learn from individuals who are at the frontier of knowledge. Okay, so if someone's at the frontier of knowledge, I might learn insight from them. But I don't learn from managers who are not producing, who are inside the frontier. Okay, so the source distribution is going to be equal to the distribution, the frontier distribution of knowledge across goods. So in this case, you just go through the equations we had before. The stock of knowledge is just going to evolve, and it's going to have this very simple law of motion, where the change in the stock of knowledge depends on, this is just the gamma function here, but the arrival rate of goods and the existing stock of knowledge that summarizes the frontier of the distribution. And beta, the strength of diffusion, tells you the importance of the existing stock of knowledge in the growth rate of the country's stock of knowledge. Okay, so it's a relatively simple law of motion. In this model, there's going to be, you can get long-run growth in this model, but to have a nice balanced growth path, you need that the arrival rate of ideas is growing over time. So as I said, this is a feature of the models with semi-endogenous growth that you sort of need population growth over time to get a balanced growth path. We're going to have that feature here as well. But if the growth, if the arrival rate of ideas is growing over time at some growth rate gamma, then the stock of knowledge in a country is also going to be growing over time. And the stock of knowledge is going to be growing at rate gamma divided by 1 minus the strength of diffusion. And you can see right away there's sort of this compounding effect of new ideas, which is prevalent in a lot of diffusion models. If Thomas learns a new idea from Sam, that's going to, he gets an insight from Sam that's going to improve the ideas that Thomas gets. If I then learn from Thomas, then if the insight from Sam can improve my insight as well. So there's this compounding effect that as ideas diffuse across individuals, it compounds the usefulness of those ideas. And this is something that there's going to be some similarities between these diffusion models and models with intermediate inputs. You can think of an insight as like an intermediate input into generation of new ideas. And there'll be some parallels between models with intermediate inputs and these models of idea flows. And it's 1 divided by 1 minus beta, because beta is like the fraction of the new insight that I learned that goes into my idea, that when that goes into the new idea that someone will learn from me. Okay, so the trade model. We're going to plug this into the just off-the-shelf trade model, the Bernard, Eaton, Jensen, Cordham trade model. They're going to be n countries. A country is going to be defined by the labor force, the size of the labor force, and the stock of knowledge within their country. And there are going to be these iceberg trade costs. So kappa ij is the number of goods needed if you ship a good from country J to get 1 unit of the good in country I. There's the household. We're going to have a household that has just standard Dixit-Stiglitz preferences with elasticity of substitution across varieties epsilon. Production is going to be linear using only labor. For an individual manager in country J, the cost of that manager to produce a unit of good, or to provide a unit of the good to country I, is going to depend on both the cost of labor in that manager's home country, the iceberg trade cost, and that manager's productivity. Okay, those 3 things summarizes the manager's cost of getting 1 unit of the good to country I. We're going to assume Bertrand competition. So the price of a good in country I is going to be, a good is going to be supplied by the manager that can supply the good at the lowest cost of production across all the different possible source countries. And the price of the good is either going to be the monopoly markup over that that manager's unit cost of production, or that manager is going to have to do some kind of limit pricing, where there's going to have to, he would like to set the monopoly markup, but there's some other manager that can provide the good at a slightly lower price, and so the manager is going to have to supply or set a price equal to the cost of production to the second lowest, the cost of the second lowest cost provider of the good to country I. Okay, so with this environment, we can write down the standard equations for the price index for a country, which is going to depend on, among other things, the stock of knowledge and all the trading partners of the country. There's the trade shares of a country are going to play a very important role later on. So pi ij is the share of i's expenditure on goods that's spent on goods from country j. Okay, so i's expenditure share on goods from country j. And that's going to depend on the stock of knowledge in country j. More higher productivity in country j is going to raise the expenditure on goods from that country, and a lower wage helps, and a lower iceberg costs shipping goods help as well. And then for each country, there's going to be a single labor market clearing condition, which pins down the wages in the different countries. And we're going to assume balanced trade as well. Okay, so in this environment, what do the diffusion of ideas look like? So we're going to focus, as I said before, we're going to focus on a couple different mechanisms that have been studied in the literature for how ideas might diffuse across individuals. So one mechanism is that individuals might learn from all the people all the managers that sell them goods. So you can think of this as I consume goods, and I might potentially reverse engineer the goods that I consume, and I might learn the productivity behind all the goods that I consume. So I might learn the productivity of everyone who sells me goods. Alternatively, we can have learning from producers. So the first, learning from sellers, this is the mechanism studied in Alvarez-Buera-Lucas. Learning from producers is a different mechanism, which was studied by Pearl Tanetti-Wah and Thomas Sampson. Individuals learn from any active domestic producer. Anyone who's actively producing in the country, I might learn from them. And the role of trade is that when trade, in each of them, trade induces some selection into either the goods that I'm consuming or the firms that are producing domestically. For each of these specifications, we could think about either just an extensive margin or an intensive margin. An extensive margin is I'm equally likely to learn from any of the different individuals. So with learning from producers, for example, I'm equally likely to learn from any domestic producer. Or we can think about these models with an intensive margin, where I'm more likely to learn from the bigger producers. Okay, so we have these two learning processes. So let me get to what we got from them. So first, we're going to talk about this mechanism of learning from sellers. So again, this is I learn from all the goods that I consume. So in this case, the change in the stock of knowledge of an individual country, it depends on, again, this is the formula we had from the first slide. It depends on the arrival of ideas and the source distribution. You can show that when you plug this into the BEJK framework, you get that the change in the stock of knowledge takes this relatively simple form, where the change in the stock of knowledge is this expenditure-weighted average of a couple of things, of all of my trading partners' stocks of knowledge. So I have the stocks of knowledge of all my potential trading partners, and there's a weighted average of all those, and the weights depend on my expenditure on those goods. And there's this extra adjustment term, pi ij here, which determines how strong selection is in the country. So if you hold my trading partner's stock of knowledge, if I spend fewer goods on that country, it means I'm getting a better selected sample. I'm more likely to consume the goods only from the most productive foreign suppliers. Okay, and so the less I trade with someone holding fixed their stock of knowledge, the better the insights I get on average from that country. So this is the mechanism that was emphasized by Alvarez-Buera-Lucas. It takes this very simple form here. Okay, so it is a selection on who sells me goods. What trade shapes who might sell me goods, and the less I trade with someone, the better selection I get. If I want to just allocate my trade shares in order to maximize the growth of my stock of knowledge, so essentially that means if I could take this equation over here and choose trade shares that sum to 1, but choose them in order to maximize the growth rate of my stock of knowledge, you would want to set the trade share, the amount I spend on goods from a particular country, proportional to the stock of knowledge in that country. So the more I spend on goods from a country, so if I have one trading partner with a better stock of knowledge, I want to trade more with that country to learn more from them, but I also want to trade a little bit less with them to get a better selected sample. And so these two forces are kind of offset. And if I want to maximize the growth of my stock of knowledge, I would set the trade share equal to the stock of knowledge in that country. In equilibrium, this is not quite the case. So the trade shares in equilibrium are equal to depend on both the trading partner's stock of knowledge and these other things, the wage in that other country and these iceberg trade costs. So if you were thinking about how an individual country might tilt its trading in order to maximize the growth in the stock of knowledge, it would want to tilt its trade toward the higher wage countries. So if you think about trading with Germany or trading with China, if you import the same amount from both countries, you get better insights from the trade with Germany because anyone who's actively importing from Germany has to have such a high productivity that they could overcome the high wage in Germany. And so ideally, if you want to improve your stock of knowledge, you would tilt your trade toward these higher productivity countries. Learning from producers is a different learning mechanism. And how does the stock of knowledge change? Well, the stock of knowledge, again, this is the original equation. The change in the stock of knowledge depends on the arrival rate of ideas. And relative to the equation before with learning from sellers, you learn there are two differences here. First, you learn with a revenue weighted average over a different production. So instead of an expenditure weighted average, instead of learning more from who I import from, here my exports are more important in determining the composition of who I learn from. So with learning from sellers, it makes sense. It's imports that matter. With learning from producers, it's the exports that matter in determining who I learn from. The other thing is that instead of learning from my trading partner's stocks of knowledge, here there's a lambda I up here. I learn from my own stock of knowledge. So remember, in this specification, I learned from all the domestic producers. And so it's an individual's own stock of knowledge that plays an important role in this learning process. So again, the mechanism that's been studied here by Pearl, Tanetti-Wah, and Thomas Sampson is that trade will change the selection of who produces domestically. When trade barriers go down, the high productivity producers are likely to expand, the low productivity producers are likely to drop out, and so because better producers are producing domestically, I'm likely to learn better insights. So again, selection matters, but it's selection among domestic producers rather than selection among people I learn from, or goods I consume. Now talk about the gains from trade. So in this model, and any other model for which gravity equations hold, we have that the real income of a country can be summarized by the stock of knowledge in a country and the country's own trade share. Okay, this is something called the ARC formula, but it shows up in all these different models. It shows up here too. So we want to differentiate between the static gains from trade, which is the gains from trade holding a country's stock of knowledge fixed, and the dynamic gains from trade, which operate through allowing the country's stock of knowledge to change over time. So we're going to build on some simple examples that were studied by Alvarez, Boyer, and Lucas, just to illustrate some of the forces that are at play here. So the first really simple example is looking at a symmetric world, a country with a world with n-symmetric countries. And if you can compute the long-run gains from trade here, so these aren't taking into account transition paths. These are thinking about steady state to steady state changes in real income. And you can compare income with free trade versus income under autarky. And you get, so the usual static gains from trade depends on this Armington elasticity. It's in the trade models, the shape parameter of the Frechet distribution. There are dynamic gains from trade as well. If the whole world moved from autarky to free trade, there are some dynamic gains from trade which depend on the strength of diffusion. They depend on how important insights are from others are in generating better ideas. And these take a similar form, and in particular, the total gains from trade, combining the static and dynamic component, take this form over here. So you get, as diffusion is stronger, as you might expect, the dynamic gains from trade are more important, relatively more important relative to the static gains from trade. Again, this formula for the gains from trade is the same formula that you would get in the ARC framework when you include intermediate inputs in production, when you have roundabout production as well, where this strength of diffusion plays exactly the role of the input-output multiplier in determining the gains from trade. And it's exactly because these new insights from other people go into the generation of new ideas, and beta measures how important the insights are in generating the new ideas. So you do get this input-output, this compounding of new ideas over time. Okay, so one thing to note, there are two special cases where the specifications of learning are the same. The learning from sellers and learning from producers. In a symmetric world, where all countries are identical, learning from sellers and learning from producers turn out to be exactly the same. You can show that. The other special case where they're the same is autarky. If all countries are in autarky, then whatever's going on in the rest of the world for a country, learning from sellers and learning from producers generates the same thing. So, yeah.
I probably should have asked this before, but was there a comparable change in who you want to export to that would induce more selection and thus more learning?
Yes.
Comparable to the import reallocation? Yeah,
so you kind of always want more selection in this model. You always want the low productivity producers to drop out, and so you get as much selection as you can. And so it's a little bit more symmetric here. So this is just a simple example. I'm going to show you a bunch of graphs like this. So what this graph shows you, on one axis is, again, we were in this world of symmetric countries, and we have openness to the rest of the world here. So 1 means that these iceberg costs are all 1. 0 means the iceberg costs are all infinite. And you can look at, as the country gets more and less open, how does a country's stock of ideas compare to the world with costless trade. So when this number is lower than 1, the stock of knowledge is lower than it would be in costless trade. 1 is costless trade here. So this is how stock of knowledge changes with openness. This graph shows you how real income changes with openness. As you can see, so beta equals 0. Again, remember, when beta equals 0, this diffusion of knowledge doesn't matter at all. We have this pure innovation model, and we're back in the world of Eaton-Kortum. And that's this dotted line here is the Eaton-Kortum model. So you could think of that as sort of the benchmark for what either the static gains from trade are, and anything else that operates through changes in the stock of knowledge would would have additional gains from trade. So a couple of things to point out. So as the strength of diffusion becomes more important, a country's stock of knowledge closing to the rest of the world becomes more costly as diffusion is more important. So that's something very intuitive. If you don't care so much about insights from others, then it doesn't really matter who you're interacting with. And potentially when the strength of diffusion is really large, when beta gets closer and closer to 1, the dynamic gains from trade can become extremely large relative to the static gains from trade. There's also, I think, did you point out, as I mentioned before, the static gains from trade are most important when a country is relatively open over here. So if you look at the line that measures the real income relative to open economy, completely open economy, you get most of the action. Changing trade barriers matters most when a country is already relatively open. Whereas if you look at where a country's stock of knowledge might change most, it's when a country is relatively closed. Okay, so the dynamic gains are really important for countries that are relatively closed. The static gains in trade are pretty important for countries that are relatively open. And again, the logic there is that if you think about a closed country, if you lower trade costs just a little bit, you get just a little bit of goods from the outside, and that through the envelope logic, that doesn't really do much for my real income. But if the first good I'm importing is coming from the best producer abroad, that can do a lot for how much I can learn from that producer. Okay, so whereas when I'm relatively open already, declines in trade costs, again through the logic, the envelope logic, can lead to pretty big gains from trade. Whereas if you think about the learning mechanism I have, if a country is already relatively open, if trade costs go down a little bit, the marginal extra producer is someone with relatively low productivity. So I'm not learning as much from this marginal producer when I'm already relatively open. Okay, so that was gains from trade in for a symmetric gains from trade, when the whole economy got more or less open. Now when I think about the gains from trade, think about a single, so another simple example that we're adopting from Alvarez, Buero, and Lucas, economy with n economies. n minus one of them can trade costly amongst each other, but there's one deviant country. One country for which trade with that economy incurs an iceberg trade costs. And we're just going to look at how the extent to which that country is closed affects their stock of knowledge and their real income. So I'm showing you 4 graphs here. The top ones are stocks of knowledge. The bottom ones are real income. The left side is one learning specification, learning from sellers. The right side is learning from producers, the other specification. So we want to compare how these two specifications of learning affect how the costs of closing yourself up to the rest of the world. So you can see here that when beta equals 0, again, is just the standard static gains from trade, or static gains from trade. And so when beta equals 0, there are no dynamic gains from trade. And so the country that closes itself off doesn't have any dynamic losses from trade, but there are some static losses. When the strength of diffusion is larger, there are dynamic losses. A country that closes itself off is going to learn a little bit less. And it's going to be costly in that a country's stock of knowledge is going to be lower with higher trade costs. Something that's kind of interesting here is the role of the strength of diffusion here. So when the strength of diffusion gets closer and closer to 1, more of the dynamic gains from trade happen right away, right as the country opens up from autarky. As beta approaches 1, almost all of the dynamic gains from trade come from just opening up a little bit, and then as the country opens up more, there less and less matters here. But when the strength of diffusion is smaller, the dynamic gains from trade are more spread out through the distribution. So a country can continue to accrue dynamic gains from trade as it opens more and more. We're learning from producers. There's things that look a little bit different. So if you think about a country that's completely open, as that open country closes itself off just a little bit, it turns out that the country's stock of knowledge can actually rise. So a country that's completely open can learn a little bit faster by closing itself off from the rest of the world a little bit. It will learn faster, but it's not good for a real income to close itself off. But it turns out that a country can learn a little bit faster by doing this. Okay, so one other thing, before we get to transition dynamics, one other thing I want to think about is how when different countries have different arrival rates of ideas, how that interacts with the cost of closing yourself off. So what I want to take away here is that the static gains from trade are most important when the economy is relatively open. The dynamic gains from trade are most important when the economy is relatively closed. For a relatively open economy, if learning is from producers, then economy can do a little bit better off when it makes itself a little more isolated. Something I should have stressed, I should have stressed later on. So if you compare across these different models with different strengths of diffusion, if you think about the experience of a country who has some trade share and moves and becomes a little bit more open, the gain that they're going to get from that move is non-monotonic in the strength of diffusion. So when the strength of diffusion is close to 1, then almost all of the gains from all these dynamic gains in trade come really early in the opening up process. So when a country is a little bit open already, it's accrued most of the dynamic gains from trade, and so opening up just a little bit more doesn't do as much. Whereas for these intermediate values of the strength of diffusion, the gains from the dynamic gains from trade are more spread out, and so a country that's already moderately open can experience dynamic gains from trade by opening a little more. And that's going to be important when we think about the experience of Korea, for example, in that the explanatory power that the raising the strength of diffusion, well, I'll get to that later on. Okay, so the speed of convergence, we can calculate explicitly the speed of convergence for a small open economy. So think about a small economy that has some stock of knowledge and is going to converge to a new stock of knowledge. You can show for the small open economy that the speed of convergence to a new balanced growth path is going to be faster with a higher when diffusion is more important. When diffusion is more important, the convergence is faster. The arrival rate of ideas at a suffix level plays no role. It's like a level term, but doesn't affect the speed of convergence to the new balanced growth path. Something else that's kind of interesting is that the speed of convergence is going to be slower under the specification of learning from domestic producers than if there's learning from all the sellers. So I'll show you that in a picture. So here we're thinking of, again, this asymmetric economy where n-1 producers can trade costlessly, and there's one deviant economy that has extremely high trade costs, and then all of a sudden reduces its trade costs to be able to trade costlessly. And so for this economy, when the deviant economy lowers their trade barriers, so they have pretty low income, immediately there are some static gains from trade. Those could be important from lowering trade costs this much. But then there's some transition dynamics as the country's stock of knowledge changes over time, as the country learns from other countries that it trades with. For learning from sellers, we get sort of a faster convergence to the new balanced growth path. Where learning from producers, it's slower. And the rationale is that if I'm a country, if I start out with very high trade costs, all the domestic producers in the country are going to be pretty in rough shape. They're pretty bad producers. If I open up to the rest of the world and I can learn from the foreign sellers, these highly productive foreign sellers, that's great. I can learn very quickly from these high productive foreign sellers. Where if I'm only learning from these bad domestic producers, it's going to take a while for these domestic producers to improve their productivity. And lowering trade barriers is definitely going to improve the selection among those domestic producers, but the domestic producers start out pretty bad, and learning from these domestic producers just doesn't do as much as learning from these very open foreign sellers. So let me go very quickly about how we're thinking about incentives to innovate. So we can do something kind of crude, which I guess goes back to a model written down by Eaton and Cordham. We can split up a population in a country into those producing goods and those innovating. And innovative activity leads to the arrival of new ideas. We can show in this environment that on a balanced growth path, in this environment, the fraction of individuals engaged in R&D is independent of trade barriers. It just doesn't, the amount that I might learn from others or anything, it just is completely irrelevant for the fraction of individuals that are engaged in R&D. So on a balanced growth path, it kind of is sensible to think about this arrival rate of ideas being constant across countries. So when trade barriers go down, the market size, the payoff from innovating expands. The market size is larger, so I can potentially sell more goods, but there's also more competition. And so it becomes more costly, less profitable to have a given level of productivity. And so these two forces kind of exactly offset, and trade barriers just play no role on the fraction of individuals engaged in R&D on a balanced growth path. On a transition path, I think we get an effect. But for the balanced growth path, this plays no role. So the arrival rate of new ideas is going to be constant across these balanced growth paths. So trade barriers play no role in that. But a country that's more open, the same R&D effort is going to lead to better quality insights. I can learn more for the R&D effort that I put in. I lower my trade barriers, I can learn more from other people. And so even though the arrival rate of ideas stays constant across these balanced growth paths, with lower trade barriers is going to lead to a higher increase in the stock of knowledge within a country. Okay, so in the last 5 minutes, let me talk about what we do quantitatively. So we're going to take this model that we wrote down, we're going to put on lots of bells and whistles, include intermediate inputs, capital, both physical and human capital, have non-traded goods, and we want to essentially build on the machinery of Alvarez and Lucas. So instead of thinking about labor, we're going to replace L in the model with equipped labor. And it's going to be labor equipped with both capital and human capital. And we get these from the Penn-Will tables. You can think of human capital as measured from Mincer regressions, kind of from the Barrow-Lee type of things. And what we're ultimately interested in is, can openness account for a large fraction of growth? And in particular, can we explain growth miracles? So I'm just going to give you just a couple of small previews of what we hope is to come with this paper. So we're going to calibrate. We can measure, in this model, we can measure the trade costs directly, or we can back them out from trade flows. We're going to calibrate the model, very rough calibration. We're going to take a model for the shape parameter, the Frechet distribution. It's going to take that a number of 5, kind of in the normal range. We're going to calibrate the growth rate of labor so that on the balanced growth path, TFP grows at 1% per year. The really hard things to calibrate, the things that we're kind of struggling with, are how you calibrate the arrival rate of ideas in a country and the strength of diffusion within a country. And you can think about different things. One specification is we just write down, assume all countries have the same arrival rate of ideas. And we can ask, for different levels of the strength of diffusion, how do standards of living vary across country? Or we can have different countries have different arrival rate of ideas. And we could think of this as if profit is taxed in some countries more than others, that can lead to heterogeneity in this arrival rate of ideas. And so we can choose the arrival rate of ideas for different countries to sort of match TFP in some early part of the period, and then sort of run the model forward and see what happens. And it's a tricky thing is when you think about these liberalization experiences, whether we should keep a country's arrival rate of ideas constant or say that policy changes in a country both lower trade barriers and improve incentives to go out and innovate. And I think in the end, we're coming down that it's going to be important to allow incentives to innovate vary on a transition path. So let me show you one quick picture here. So this is sort of a heroic attempt asking trade barriers to explain all of the dispersion in real income across countries. So what this model shows is for each country, a dot is TFP relative to the US. The x-axis is what we see in data. The y-axis is what happens if we back out these trade costs for the different countries, pick a number, or pick a number for the strength of diffusion, and just see what the model implies for cross-country income differences in 1960. So when beta equals 0, there's no strength of diffusion. We can't explain essentially any of the cross-country income differences. So perfect success in this model would be if all these dots lined up along the 45-degree line. That would mean we explain all of cross-country differences by just looking at differences in trade costs across countries. As the strength of diffusion gets larger, we can do a little bit better. So countries that have less income, the model implies that they're trading a little bit less and they have lower stocks of knowledge than the more rich countries. The strength of diffusion gets really large when beta equals 3/4. We can you get a much more dispersed picture. We can explain much bigger differences across countries. It's not so obvious. So these dots, I don't know, maybe they move closer to the 45-degree line, maybe not. I'm not quite sure. And when the strength of diffusion gets closer and closer to 1, we actually explain less of the cross-country income differences. So this picture was generated assuming that all countries had the same homogeneous arrival rates of ideas, and explaining all the differences in just trade costs. And I think a picture like this makes us say that if you want to understand cross-country income differences in 1960, just changes in trade costs, that's not going to be sufficient. You need differences in the arrival rate of ideas and our incentives to innovate. So we're kind of moving in that direction. I want to show you some pictures for Korea. So in this model, we look at how the TFP in Korea might evolve over time under different assumptions. So the top pictures are Korea looking at Korea. The bottom pictures are US TFP. And the left specifications are the specification of learning from sellers. The right side is learning from producers. The difference in specifications across these two different models doesn't do too much. So I want you to more focus on one particular picture. So for these models, this dotted line at the bottom is when beta equals, the blue line is data. This is TFP in South Korea over time. This dotted line is what you get with a static gains from trade, the usual gains from trade model. And opening up gains from trade doesn't explain very much of the increase in TFP within Korea. We can increase the strength of diffusion and ask how much better can we do if Korea is learning more from people abroad. So if we increase the strength of diffusion a little bit, we explain a little more of the growth in TFP in Korea. So as Korea is learning more from others, as you might expect, TFP rises more quickly as it opens up to trade. If we increase the strength of diffusion even more, we can come even more closer to the actual experience of Korea over time, only up to a point. If the strength of diffusion goes too high, when beta gets closer and closer to 1, we can then explain less of the experience of Korea. So when the strength of diffusion is too high, then Korea, at the level of openness that they were in 1960, they've already accrued most of the dynamic gains from trade. And so the additional openness just doesn't do as much. So it's these intermediate levels of the strength of diffusion that seem like they have the most promising potential to explain the dynamics of South Korea. So yeah, I think we have a lot of work to do here. We really, our ultimate agenda is to really do a full quantitative exercise. I think the way we're thinking about trying to calibrate the strength of diffusion is to try to match some of the moments, try to match the thought experiment that Jim Farrer did in his very nice papers linking the openness to strength of diffusion. And so there's some ideas there, but I think we have still a long way to go on this paper. So thank you.